Every day, most traders around the world dive into the stock market, forex, or crypto with the dreams of making millions. So these traders are all searching for that perfect pattern, that one breakthrough moment to achieve their financial goals. But have you ever wondered why, despite identifying so many promising patterns, most traders still end up failing? Why do traders, even with the so-called extensive knowledge of patterns and strategies, often see their investments crumble? Could it be that these patterns aren't as reliable as they seem? What if I told you that the very patterns you're relying on might be nothing more than an illusions? This phenomenon is known as the clustering illusion, or clustering bias. It's a cognitive bias that tricks our mind into seeing patterns in random data. And if you're a trader, this bias can be your worst enemy. Here's how it works. The market is full of noise, random fluctuations that don't mean much on their own. But our brains are wired to seek order, to find meaning in chaos. So when we see a few successful trades or patterns, we convince ourselves that we've spotted a trend. Clustering bias occurs when we perceive a sequence of events, like series of winning trades, as a meaningful pattern. The reality, though, is that the market often operates on a level of unpredictability that defies these perceived trends. But here's the catch. These patterns might just be random clusters with no predictive power at all. This is where many traders go wrong. They trust these patterns too much, leading to overconfidence and, ultimately, losses. And it's not just traders who fall for this illusion. Clustering bias happens in all areas of life. Take gambling for instance. Gamblers might see a winning streak in a game of chance and believe they've cracked the code. But in reality, it's just the randomness of the game at play. In sports, fans might think a player is on fire because of a series of good performances, despite the outcomes being largely random. Even in healthcare, clustering bias can lead to mistakes. A doctor might perceive a pattern in patient symptoms that suggests an outbreak when it's actually just a coincidence. Clustering bias can lead to costly mistakes, whether you're trading stocks or making decisions in everyday life. The key to overcome it is to stay skeptical of patterns that seem too good to be true and to always consider the possibility of randomness. So, the next thing you think you've spotted the next big trend, take a step back and ask yourself, is it really a pattern or just a product of clustering bias? That's it guys, thank you for watching. I hope you found this insight helpful and that it helps you wake up to the reality that stock market prices are completely random and not assigned to buy or sell stocks as those stock market gurus are claiming. Wish you success guys and see you on the next one.